All right. So, as I mentioned here, we'll be talking about some US real estate specifically for Canadians. As I mentioned there as well, here's my contact information. So feel free to take a picture of that if you'd like. But I will be putting it up at the end of the presentation as well for all of you who may miss it. Before we get started too far, I always like to put a bit of a disclaimer here. Taxes can be complicated, and every individual situation, your situation should be evaluated individually and separately. Our goal here today is to provide you with some general information to get you started, but please talk to your advisors about your situation. What we're doing here is, again, providing you some general information. This is not specific financial advice. A quick overview of what we'll be talking about here today. We'll talk about a bit of bookkeeping. It may get overlooked from time to time, but it is quite important in getting started. It's quite important in the tax process, structuring your portfolio, etc. So we'll touch on that. We'll talk about structuring your real estate in Canada, as well as how your rental income is taxed here in Canada. And then we'll move into structuring your real estate in the US. We'll talk about the tax filing process both in Canada and the US, and we'll talk about how those both interact with each other and how they affect one another. We'll then talk about a few risks that are present as in cross-border accounting here and cross-border taxation. And then, as I mentioned too, there will be some time at the end for questions. So we'll try and breeze through this to leave enough time for that. But first, a little bit about who I am here. As I mentioned, I'm with an accounting group called Grenier Group CPA. I'm a senior manager here, and I specialize in cross-border taxation and real estate. I am from Winnipeg, but I actually lived in Wisconsin for 4 years. So I do have some lived experience with the cross-border world. Two questions that I often get asked by people is, who do you work with and what do you help them with? So I work with all sorts of different clients, ranging from athletes to business owners, individuals, and investors, both US and Canadian residents. And their situations could be anything from someone who's planning a move across the border to someone who is planning on investing in real estate. Whether you're working in the US or in Canada, there's always situations that present themselves that you might need some specialized information. So then I provide everything from consulting on these situations. I help people who are planning on, again, investing and setting up structures in real estate, people who are planning a move, as far as going then for tax preparation. So I can prepare US tax returns, Canadian tax returns, and then plan that whole process out for you as well. On top of that, just given my area of expertise here, is I do have an extensive network of professionals who maybe have expertise in areas that I don't. So immigration, for example, I have many immigration lawyers and specialists in the area if you are looking for that cross-border expertise. Oops. So with that being said, let's jump right into it here. Let's talk a little bit about bookkeeping. And bookkeeping, it's crucial. It can be overlooked, but without quality bookkeeping, we can't provide any sort of analysis on your portfolio, any sort of tax planning, or even preparing an effective tax return. Bookkeeping is the foundation of all of this. We talk a lot about having a data-driven analysis, a data-driven approach. Without quality and timely bookkeeping, we cannot have that data-driven approach. So we need accurate records. And that goes for analyzing properties, creating a tax plan, or creating a tax structure across the US and Canada. And then on top of that, bookkeeping must be up to date. So if you are not up to date, you can get caught in getting behind on your taxes. You can get caught in not having up-to-date information to make those educated decisions. So very important that it's accurate and up-to-date. And then another area, again, that often gets overlooked is CRA and the IRS. They do review your tax returns. And if we know what's going on in your return, if you know what's going on in your return, we still need the paper trail to show that to CRA and the IRS. So quality bookkeeping is essential to respond to any of these reviews. Now we'll talk, like I mentioned, most of the presentation here today, most of what we'll be talking about is structuring your real estate portfolio. And this is often what I find is the biggest hurdle for people to get started. So in structuring any type of business, there's three areas, there's three things to consider that are the main areas, the main benefits of a business entity. And that is the tax treatment of the entity, the liability protection that you may or may not receive, and the maintenance costs. The maintenance costs are ongoing costs, such as legal fees and accounting fees that, again, are an annual basis that you have to, you incur these costs every year. Now, there are startup costs associated with many of these structures, but the maintenance fees is something that we want to consider. Other things that we will consider, again, there's a balance between each of these three areas, and then we'll look at some other considerations to try and find that balance that works best for you. So we look at things like the size of your business, do you have any investors, are you raising capital, etc. So a few of the property or a few of the entities that we're going to look at here, both in Canada and the US, we'll work at filling in this chart throughout the presentation, is a corporation, a partnership, just holding the properties individually. And then in the US, we'll look at C and S corporations, LLCs, and again, individuals. And we'll go through the different areas to consider, the pros and the cons of each. And again, please note, we can actually use a combination of these entities. So the first thing that we have to look at is how is rental income taxed in Canada? So if you hold property in your personal name, it's quite simple. Your rental income gets taxed on your personal tax return, and it's taxed at your marginal tax rate. So whatever your marginal tax rate is, that income will be adding to your taxable income, and it will be taxed at that appropriate rate. Inside a corporation, it's a little bit more complicated. It can be taxed in one of three ways. It can be taxed as active income at either the small business rate or the general rate. We aren't going to jump too far into the difference between those rates. It's a little bit outside the scope of what we're looking at here, but just know that rate is 9 to 31%, depending on the province that you're in. Lastly, it is in a corporation, rental income is taxed at about 50% if it's classified as investment income or passive income. That's very important to note, and that is generally how it's taxed in a corporation, is at that 50% rate. If you have a partnership, your rental income flows through to each partner. So you can have individual partners, you can have corporate partners, and that income will be taxed according to whatever the partner is. So now, I mentioned that in a corporation, you can talk about passive income or active income. So this depends a little bit on what services are being provided above and beyond the traditional rental services. So traditionally, obviously, the tenant is paying a rent and they are getting a place to stay. If you want to turn your passive income into active income in Canada here, we need to provide additional services such as cleaning services, security, meal service, etc. And usually we need to see employees. We need to see full-time employees to consider the income active. Usually this is around 5 employees, and CRA is very strict on these rules. If you have a passive investment in a real estate, it can be very difficult to classify that as active income. Because of this, rental income in a corporation is generally classified as passive, and it's taxed at 50%. A quick example of the difference here is a traditional apartment building compared to something like a nursing home, where now you're providing more services above and beyond just the traditional rent. So now we'll go back to our table here and look at some of the pros and cons to each structure. So looking at the tax rate here, again, corporation we touched on is 50% tax rate generally. Your partnership will be either the marginal tax rate of the personal or the individual who is a partner, or the 50% rate if it's a corporate partner. An individual, it will be taxed at their marginal rate, as we mentioned. Liability, this would be your exposure if something happens, if you get sued, if you have creditors coming after you. In a corporation, that liability exposure is limited to your initial investment. A partnership, again, it depends on if the partner is a corporation or an individual, and an individual has unlimited liability. Our maintenance costs for each, corporations and partnerships both require year-end work. Generally, financial statements will be prepared as well, and they require a separate tax return. So because of this, the maintenance costs are fairly high for both of them. For an individual, it would just be the cost of your individual tax return. So maintenance costs would be a little bit lower. I put medium up here. Again, we still advise, we still recommend work with advisors, work with a professional. So there still will be some costs, but they will be much lower. And finally, some ideal usages for each of these entities. Corporation is if you are an active real estate business, if you're looking at limiting your liability, or if your personal income is already at being taxed at 50%. So if you're already in that top tax bracket, you might not be saving any tax by not incorporating, by keeping your rental income on your personal return. As a partnership, it's ideal to use this if you are a larger operation and multiple owners, or if you're having if you're using a GP and an LP. So if you're raising capital, if you have multiple people taking part in a project, that's when you can use a GP and an LP and use a partnership. For individuals, it's best to use this if you have a smaller operation. Again, because the liability is unlimited, there is some risk here to not using a corporation. So I quickly want to touch on the tax rates in Canada here. We're talking a lot about tax planning. We won't spend too much time on this slide here, but again, please note, these are the Manitoba tax rates. And as you can see here, the top tax rate is 50%. So if you are at that $246,000 personal income, at that point, you will not see a benefit from keeping your rental income or your rental property on your personal tax return. And at that point, you definitely should, look at incorporating because you won't be saving any tax on the tax rates there. I also want to point a bit of attention here to the capital gains rates. So there was a recent change proposed in Canada to capital gains. So these rates are not updated for that change. We're not going to talk too much about that here today. Just again, please note that these rates are not completely accurate, as they may be changing here coming up. We're going to move into the US now, but first I want to reiterate the areas to consider when structuring your real estate business. So the tax treatment, liability protection, and maintenance costs. And those will still be true even in the US, even with the US entities. So in the US, there's three main structures that we look at. The first is a corporation. There's two types of corporations available. One is a C Corp, one is an S Corp. C Corps have a very high level of regulations and complexities, and they're subject to double taxation, so they're not usually a great option. And S Corps, you must be a US citizen or a legal resident of the US, so again, not a great option. Sole proprietor, so this would be similar to in Canada, just keeping your rental property on your individual tax return and holding it personally. The big issue here is there's unlimited liability, and in the US, there's a greater risk of liability exposure. So there's a greater chance of being sued. There's a greater chance for there's a greater need for that liability protection. So being a sole proprietor with rental properties is not your best bet. Finally, there's LLCs, limited liability company, and this is a great option. It's generally the best option because it provides you with liability protection. So the way this works is it's a flow-through entity. So the income from your LLC will flow directly to your personal tax return, and it will be taxed at your personal tax rate, so your marginal tax rates. And LLCs can have multiple owners. So if you are looking for some investments, you can still have that. You can still facilitate that. Now, again, moving back to our table, now we can compare each of these structures. So we can look at, our C Corps and our S Corps first. The C Corp tax rate is 21%. The S Corp is a marginal rate as it's a flow through. All the income will end up on your personal tax return. Liability is limited. I'm just going to skip down to the bottom here. The C Corp is very complex. It's useful for large entities. In a situation like this, it's not something that we would want to consider. And an S Corp, again, we can't have foreign owners, so this is not something that we can consider either. Next, I'm going to skip the LLC, come back to that in a minute, and we'll talk about holding your property as an individual, as a sole proprietor. So this gives you the tax benefit of being taxed at your marginal tax rate. However, the liability is unlimited. We briefly touched on this already. This is an issue because there is more risk in the US. There's a greater need for liability protection. So this makes being a sole proprietor unattractive for the business of rental properties. Maintenance is medium, but again, unlimited liability is a big issue here. So now we'll talk a little bit about our LLCs. Your LLC, you'll be taxed at your marginal rate again. The income flows directly to your personal tax return. However, the liability is limited. So this gives us the benefit of being protected from exposure, protected from creditors. So this is the big benefit here. And the maintenance isn't too high either. This can be included, your LLC activity can be included on your personal tax return, which keeps costs down. The cost to maintain this is much lower than a corporation. It's generally about $100 a year just to file a couple forms for the LLC, and then your personal tax return as well. So going back to the ideal use for an LLC, it's generally for Canadian investing in the US. There are many benefits of an LLC and many different areas to use it. But we're just going to focus on, Canadians investing in real estate in the US. So this is generally a very good option.